All right, welcome back to Rockstock Channel. It is Thursday, June 19th, and we're back with a favored guest, Matt Fernley, to talk about lithium and a couple of other battery materials. Matt has been on the program a few times and publishes the Battery Materials Review and also has a podcast called the Recharge Podcast. Matt just published his latest BMR. And as I did publish our lithium ion bull, these are both kind of monthlies. My title was, the long run, taking a page from the Eagles. And I referenced Matt in that note because 21 months ago, I also came from the Eagles' Long Goodbye concert and thought at that time, lithium would take it to the limit one more time. And he responded to that email saying, you may look at Africa. Have you looked at Africa? Because he had taken his numbers down in July 2023. And I didn't exactly ignore him, but I focused on what was happening in Western Australia M&A with Chris Ellison and Gina Reinhardt, and SQM by Mazur and Albemarle, et cetera, and saying, surely these companies who are plugged into selling into China know better. Well, here we are in month 31 of a bear market since the November 22 top. I mentioned in that lithium bull that the last down cycle from January 2018 until November 2022 was 34, 35 months. So we're still have 3 months to go to be as long as the last bear cycle, top to bottom. We had Ken Hoffman on the program recently giving a very bullish take. We've had a lot of positive feedback. I'd encourage viewers to look at that and get a bullish review. He's in a bullish, like YJ Lee from Arcane Advisors, an analyst we had on a few months ago. But there's still quite a bit of bearish sentiment out there. I was at the Benchmark Minerals Giga USA conference and I ran into the bear, Chris Robb, in our bull bear debate from November. And it was the first time I had seen him in 6 months. And so he said, I told you, things got worse. I had argued bullishly in November with the 3-year view, that lithium still looked good, but he's still bearish, quite bearish. Chris, he's seeing ramp ups at, Ganfeng's Goulamina and other, Kathleen Valley. So he just sees lots of supply. And I have a note here I just got yesterday from Ben Isaacson of Scotia. Also, fairly cautious. He was kind of making an argument that, we all got caught out. We thought like 25 was the bottom, then 20 was the bottom, then 15 was the bottom, then 12 was the bottom. And now here we are at 8,500. No one thought we would get this low on the lithium price. So Matt, we've been talking, and I think you're somewhat in the middle here, as is Rodney. We just spoke. You have 2030 lithium demand forecast of, I think, 3 million tons. Rodney's at 3.3. YJ Lee is at 4.3. But if you go now beyond that to 2035, I think you're at 6.1. I referenced in my note, my optimism is, again, going to the Eagles. Rio Tinto's focus on the long run, and they argued they see lithium growing 10% a year over the next 15 years. So that's 3 times GDP. But if you extrapolate that, or if you look at that like on a consistent 10% per year, they'd only get to 3.7 million tons by 2035, and 6 million tons, by 2040. So you're meaningfully more bullish than Rio is. And so I'd like to just, talk with you about that. The lithium is volatile. And it's been boom bust, 2 to 3 year bull, 2 to 3 year bust, where in a bust, we've got to be close to the bottom. We keep saying that, but, with that lead in, I'll let you share your thoughts, from your overall thoughts, but you did just publish the BMR, so you can kind of talk about that. And just by the way, if you want to get the BMR, you can visit, I think, the Battery Materials Review website. And if you want the Lithium bulk emailed to your email box, please visit rkequity.com and register your email there. And of course, if you like this video, please like and subscribe to this channel and hit the notification bell to make sure you're notified every time a video is published. Welcome back, Matt. What say you?
Okay, thanks very much. Thanks very much. So, I mean, big question there. Not just in terms of length, but also in terms of impact. Um, I think so. My thoughts on lithium. I mean, as you said, in the medium term, I'm possibly a little bit more bullish than consensus. In the longer term, in the near term, I do see an oversupply. In the next couple of years. We can come around and talk a little bit about the cost base in the industry in a second. But for me, we're at around about sort of 60,000 renminbi a ton on lithium carbonate now. That's just below $8.50 a kilo. Um, Number of commentators have suggested that we could go to 50,000 renminbi a ton. That's just over $7 a kilo. That's practically the cost of operation for low cost brine producers in Latin America when you factor in royalties and everything. So that's like bargain basement level on the cost curve. And that's what 10% down from current levels. So I think if you look at lithium from a risk reward basis, I think we're much closer to the bottom than a lot of commentators are suggesting. We could have, maybe 10% downside from here in prices, maybe 15% downside from here, but I can't see prices going materially lower than that because then everybody in the industry is bonged out in terms of profitability. So I think, from my point of view, I think we're at the bottom. Is it a U-shaped recovery or a V-shaped recovery? Um, there's a few bulls out there who are very vocal. Most people are more conservative slash bearish. I think we need to see production cuts. We need to see production cuts from high cost regions. And if we get those production cuts from high cost regions, yes, we could get closer to a sort of V-shaped recovery. But if we continue to bang around on the bottom for a while without production cuts, then I think we're looking for a U-shaped recovery that could persist for probably 6, 12, possibly 18 months or whatever. So, if I was a value investor with a longer term price investment horizon, yeah, I'd be picking stuff up here. Particularly the low cost assets in either the brine space or the hard rock space, um, that can make money through the cycle at these prices. Yeah, I think that because this has been such a boom bust space, maybe people have been sort of focusing a little bit too much on their sort of racy sort of development stocks and the sort of higher cost producers. We have to go back to the view that if I want to make money through the cycle, then I've got to be looking at low cost producers.
Matt, a question from my side would be, and I guess it's also kind of a concern, is that we haven't seen producers cave at these prices. So what does that mean if prices recover to $10,000 to $12,000 a ton? Are we facing the prospect of possibly production expansion in that range?
Well, I think because we haven't seen producers cave, we won't see prices recover. We'll only start to see prices recover once producers cave in and cut production. On my numbers, we've got oversupply in 2025. We'll have bigger oversupply in 2026. So we need to see producers cut production before we have any chance of prices recovering. And the other issue, just to be aware of, is it's not just a year-to-year sort of supply-demand issue. If we have oversupply of the magnitude that I'm forecasting over the next 12 to 18 months, there's going to be a lot of inventory sitting around, which is going to need to be worked through as well. So it's not just a question of saying, oh, I'm more excited in 2029. I think the market will be in deficit. Well, it might be, but there might be so much inventory sitting around at that point that you need to see an inventory drop before prices would start to recover. So I think that's something to really be aware of as well.
So while we're on that theme, Matt, if you look at China and the number of EV producers and what's happened with supplier payments blowing out across a lot of the OEMs, is there a risk that we see another round of OEMs and battery producers not making it in China and then causing another glut of materials, battery cars coming onto the market?
To tell you the truth, I'm not too worried about that. I mean, I think BYD kicked off the next round of the OEM price war in June with a 3-month price offer on two of its major lines. They're clearly trying to push some of the higher cost producers out of the market. But when you look at the market, the top 10 producers in China dominate. So if we get, large scale um, collapses of niche EV producers, that's not really going to be an issue. And for me, there's still, and also for the Chinese government, there's still too many EV companies knocking around in China. They're very keen to condense that into a number of national champions rather than having too many small producers around. Similar to what we see in Europe and the US, we have a very small number of very large OEMs, and that's what China is trying to move towards. So I'm not too worried about that. In the battery space, it is a difficult industry to be in at the moment. Profitability is low unless you're fully integrated like BYD and CATL. But interestingly, the battery names that have more production in ESS batteries, they've been enjoying higher profitability than those who are in EV batteries. But similarly, again, technology is moving forward so rapidly on more the ESS side, but also to some extent on the EV side over the last 12 to 18 months, that I do expect some of the sort of tier 3 and tier 4 battery producers to fall by the wayside over the next sort of 3, 4, 5 years. But I think that's a good thing in terms of the Chinese government. I think they would be pretty happy if the industry became more streamlined.
And Matt, I mean, I must say, you just mentioned it. I'm blown away by where things are going in the energy storage market and going up over 1,000 amp hours already, which is just like I was hearing 528 the other day. Now we're at 1,100 or something. So,
Yeah, I mean,
and
I was talking about that, and actually, my last but one issue of BMR was a focus issue on BESS, and the technology change that we've seen in the ESS space in the last 3 years is amazing. I mean, 3 years ago, the most common ESS product was about a 2 megawatt hour, 20-foot container product. Now, standard is about sort of 6 or 7 megawatt hour liquid cooled LFP container product. CATL just launched a 9 megawatt hour stacked product. I believe Goshen has launched a 20 megawatt hour product with large cells. The change is absolutely amazing. And because of that, you're getting much higher cycle life, much higher efficiency, and much higher energy density than we got in the initial stages of BESS, and that has a huge impact, which I don't think is being picked up by analysts on the economics of BESS, and in particular on the economics of renewables plus BESS. So if you look at the Lazard LCOE analysis, which I think just came out last week for this year, the LCOE for solar PV plus BESS is now less than for a gas peaker plant, a lot less than for a coal plant, and the same for onshore wind plus BESS. So we are actually seeing a step change in profitability, And for me, that's one of the factors that a lot of analysts are not picking up on. And that's why their forecasts for solar, but also for solar plus storage, are much lower than they should be structurally.
And Matt, with the change in form factor, your thoughts about energies, energy storage taking bigger market share and longer duration?
Well, I mean, with battery prices at these levels, with lithium ion battery prices at these levels, you can compete with long duration storage solutions like flow batteries, etc. If battery prices go up from here, then maybe you'll see a move towards longer duration strategies. I mean, realistically, we need to see hybrid batteries. So we need to see some long duration mixed in with lithium ion. But again, we've seen the duration for lithium ion rise substantially over the last few years. 3 or 4 years ago, the average duration for a lithium ion battery was less than 2 hours. Now it's approaching 4 hours. And some systems, by doubling up, by trebling up, you could get to 6, 7, sometimes 8 hours. So lithium ion is moving forward fast to become the solution. And the thing about lithium ion versus flow batteries is a bit like the sort of Betamax to VHS debate. Flow batteries is kind of the Betamax, but it's never had that sort of gigafactory moment. Lithium ion is the VHS, but it's commercial and you can invest in it commercially. And when we speak to people in the market who are looking at the technologies that are around at the moment, they're saying, well, we trust lithium ion because we've seen it in action. There are very few places in the world with flow batteries of the sort of scale that we're looking for. So we can't really trust that data. And that's really the issue that flow batteries are banging up against, that they need somebody to really take a chance on them on a large scale, and other long duration technologies. And at the moment, because lithium ion prices went so low, nobody's really bothering with other long duration technologies.
Matt, I was on the phone yesterday with John Canalicis, the chairman of Lithium Argentina, who was just with Ganfeng and his team in China. Once a year, they kind of go there. He said he was actually talking to me from his Model Y with FSD, and actually referenced as well. Chamath Palihapitiya was talking about this, and there's a lot of stuff on Twitter about robo taxis and how Tesla's valuation is clearly factoring in both that and robots. John said everybody in China is crazy over robots. There's nothing negatively impacting the long-term demand story, but he saw the cost curve is coming down. The lepidolite producers costs are coming down. I think this is something you mentioned, Matt. So could you comment just, I guess, on other demand drivers, from robo taxis, robots, drones, on the demand side, kind of globally, but also from what you in November, I think, were on the program, you had visited China and made some comments about costs coming down, on lepidolite as well. So there's
I
a
mean,
lot in what I just asked, but address what
yeah.
you like.
I mean, I think on the demand side, there are other drivers coming through for lithium ion batteries. But the batteries used in drones are tiny. They're sort of almost sort of in most drones, sort of like the consumer size batteries. So I don't see that as a sort of major near-term driver, and ditto in the robotics. I mean, it'll be helpful on lithium ion. To tell you the truth, on the robotics and drones, I see more driver for rare earth demand than necessary for lithium demand. And I think that looks very, very exciting indeed. Um, in terms of the cost structure, I think the Chinese lepidolite industry is very badly understood by commentators in the West. Um, when I talk to people wanting to get information about the Chinese industry, um, I often find them asking the wrong questions, focusing on sort of stripping ratios and stuff like that. For me, the major issue with lepidolite in China, it's byproducts. Um, Insofar as the fourth generation lepidolites, so not the sort of early stage ones, but the much later lepidolites like the CATL plant, other plants that have just been built in the last 12 to 18 months or so. Those sort of operations, that they benefit substantially from byproduct credits. So sodium sulfate, which is used in building materials, but also heavy metals like tin and rubidium and cesium. Those can be sold off into other Chinese operating silos. Quartz and feldspar, they can be used for building materials. So you are actually generating quite a substantial byproduct credit out of those light operations. On a gross basis, yes, they are high cost, um, because the in situ grade is quite low, much lower than for a spodumene operation. But there are other considerations that I don't think that people are also picking up on for the lepidolite operations from the mining side. I mean, the first issue obviously is lepidolite as a mineral. Its work ratio is much, much lower than for spodumene. It's a sort of mica mineral, whereas spodumene is a much harder mineral. So, for starters, you don't need to use explosives in the bulk of these lepidolite mines, just free dig. There's not very much stripping because you're basically taking it off the top of a hill. And then when it comes to the concentrating with the Western Australian spodumenes, you're crushing and grinding it to a micron size so that you can free the iron, and the iron doesn't go in with the spodumene. In the lepidolite, you're not having to put so much work in, so much power to grind. So some of them you can crush only, some of them are grinded, but because they're much softer material, you don't have to put so much energy in to free the mineral, and that's absolutely key. So and also the energy costs in China are much less, and then added to that, the transportation distances are much less. So I was in this area in November. You'll maybe moving the material 10 kilometers from the mine site to the concentrator. Um, you could do that by truck, but increasingly they're building conveyor belts. Then you're moving the concentrated material maybe 40 kilometers to the carbonate plant or the hydroxide plant. Now, if we contrast that with Western Australia, you're mining it, you probably move it a couple of kilometers by conveyor to the concentrator. Then from the concentrator, you could be shipping it anywhere between 100 and 300 kilometers to the coast, and then by truck, and then you're moving it probably to China by ship. That's a couple of thousand kilometers. Then you're moving it inland from the port in China to the processing hub. So the transportation costs are very, very substantially larger as well. And I think that's one of the things that people are not picking up, in line also with the issue of byproduct credits. So I don't see the lepidolite industry in China as being quite as high cost as a lot of commentators do, because I think a lot of commentators think it's just spodumene, but with a different name, and it's not.
What about the environmental aspects of it? Everyone says it's like very dirty compared to other forms
Well,
of lithium mining.
I mean, it's only dirty in terms of the fact that it creates a lot of waste. But as I just said, it doesn't have to create waste. The new fourth generation plants, um, we went to one on the trip. They're only creating 2% of waste. The rest of it all goes into other usage. So, it doesn't have to create waste. The old plants did. They created a lot of waste. But increasingly, there is a focus on environmental management in China, and it's just not acceptable to sort of create that level of waste. Um, and it all depends on how you treat the deleterious waste elements. In the new fourth generation plants, they're taken out at the front of the flotation, the processing flow sheet. In the old plants, they were left to the end, and therefore they contaminated a lot of the other waste material. But if you can get the deleterious elements out first, then you're not dealing with hazardous waste. You're only dealing with industrial waste material, and it's a very different cost of processing it.
Okay. All right. So very much a bit of a different take on the lepidolite. angle. What you're saying there is that kind of the low grade, but the soft mica. Uh, there are some other mica deposits out there. I know we represent, and have talked about your European metals holdings. And they've talked about high recoveries. So your bullish comments, on the soft, material, but also, in Nevada sediments. I mean, Lithium America is low. It's high grade from if you look at it from a ppm perspective, from a uh, sediment perspective, but on a relative to hard rock, it's relatively low grade, right? But the soft material, right? So if you're
That's a slightly different processing pathway because you have to blitz it with high purity sulfuric acid or acid to break down the clay minerals. So yes, it is soft. It probably is free dig, but it's a different processing pathway to what we see in the lepidolite assets.
right, okay. You referenced capital raising has deteriorated. Yeah, so could we just talk about that because we just saw Winsome Resources decided not to exercise their option in Renard Reserve Capital. A lot of companies are struggling to kind of raise capital in the lithium space. So your projects are being slowed. So what's your,
I
we could
mean,
flash up some of your data,
yeah.
quantitatively, but if you could speak to the quantitative and qualitative, implications of that.
Yeah, I mean, I actually, I mean, it's tough for the companies that are trying to move forward. I actually see this as a positive for the industry. So what we've seen, obviously, is the weakness in the lithium price over the last 12 to 18 months has really impacted the amount of equity that companies are able to raise. So they've had to try and look at other sources, and whether that's project finance, offtake prepayments, grants from government, debt financing. That's really started to sort of dominate. But of course, all of those are really only viable once you're at a later stage development. So it's impacting the ability of some companies to explore, early stage explorers to explore new projects. If you're in a part of the world where you can't access this government support, then it is really a problem for development stage projects as well. But I can't help but come back to sort of 2018, 2019, when we had the same situation in the industry, a lack of capital availability, and that effectively was the catalyst for the massive bull market that we had in 2020 and 2021, because the industry stopped investing. And kind of that's what we're seeing now. I mean, in the last sort of 12 months or so, we've seen a huge drop in capex, even by the existing producers, companies like Albemarle, SQM, um, Livent in the old days, Arcadium, have dropped their capex. As a result of that, a lot of projects that potentially were on the drawing board, or expansions that were on the drawing board for 25, 26, 27, have been delayed. A little bit more of that. And I think it's positive for the industry. And it all comes back to this issue of the sort of risk reward in the industry. We are starting to see, delays in capex coming through. So if we can plow through this near term oversupply in the industry, and we're not financing a lot of new projects, then you are improving the conditions for a recovery. I'm pretty convinced that we're close to the bottom in the industry. The question is how long we bounce along on the bottom. And I think it could be for a while longer yet. But for me, for my PA, I've started buying low cost lithium producers because I think there's a lot of value in some of these stocks. So I think that's indicative of the way that I'm trading the sector at the moment.
If you don't mind, which ones are you buying?
Well, I can tell you now, when we spoke before, I was on the buy side, so it would have been a conflict of interest. But the stocks that I'm buying, for me, are Lithium Argentina, which you referred to earlier, new development or recent development, shall we say, in Argentina, ramping up production, good partner in Ganfeng, lots of knowledge, and for me at the moment it looks ridiculously undervalued. And then the second one is a company I followed for a long time on the buy side. Finally, in a position where I can buy some, I'm very excited to buy some, particularly at this level, which is Sigma Lithium, which is hard rock in Brazil. And I think one of the things that a lot of people don't understand about Brazil is the mineralogy of the hard rock assets is so fantastic compared to potentially all of the Western Australian hard rock assets, with the exception of Greenbushes. And the thing I like about Sigma Lithium is they don't have to grind to micron size grind. They can crush the material and just ship it. That frees enough of the high quality spodumene. So it really genuinely is a very low cost producer. And the other thing that really excites me about Brazil is that they've got everything there for the battery value chain. So, at the moment they're shipping material to China. I see a large possibility within the next 5 or 10 years that there will be lithium hydroxide, potentially cathode production in Brazil for the battery industry. Now, there's already a very small lithium hydroxide plant in Brazil, but potentially we could see industry scale. BYD is there. They've built an EV factory, or they're building an EV factory. Brazil has graphite. It has low cost power. It has lithium. It has manganese. It has cobalt. It has nickel. It has phosphate. It has everything that you would need to build a viable battery industry there. So I think, structurally in the long run, I'm very excited about Brazil as a country as well.
Matt, if I could just ask, what is, in your mind, what is the implied lithium price on those companies that you seeing the value at?
Yeah, I don't really look at it in that way. I look at it in terms of where the companies sit in the cost curve at this stage of development. So I'm not really trying to understand what the implied lithium price is. I'm trying to understand whether the company can be profitable through the cycle. That's the way I look at it for
If
an
it can
investment.
wash its face, then
Yeah,
it's doing well.
yeah. That's the way I look to invest at this stage of the cycle. But at a different stage of the cycle, if we were talking and we were saying, look, I believe that the cycle is recovering now. I'm buying for the recovery. Then I'm buying a different type of company. Then I'm buying a higher cost asset that's more operationally leveraged. But for this point in the cycle, you're looking for really good value, for something that can make money through the cycle. That's how I'm looking at it.
What's interesting about both of those companies, and I agree, I own both, and but both are listed in the U.S. in addition to in Canada. And what we've seen in the last few months in the U.S. is some kind of meme stock behavior in a number of companies. One we just interviewed again yesterday is the metals company, but and you mentioned you're bullish on rare earths, on robotics, etc. Uh, Rare earths are the Achilles heel in the negotiations between China and the U.S. On trade. So MP Materials has done well. Again, these are U.S. listed stocks. TMC U.S. listed stocks. Uranium is having a nice bull run. I own the URA ETF. And so uh, I like, if lithium gets a bid, right, the lithium price stops falling, right? If lithium goes to what most people are saying is the long-term forecast in most analysts is about 14 or 15,000. The incentive price is like 20,000. Right? So if it just gets to either of those, right, it's a near doubling from where we are today. And if you get a doubling in the lithium price, then producers, are highly leveraged to that, right? And their earnings, so those stocks I think could double or triple, if
I
lithium
mean,
price, doubles or
the
triples.
other thing that I would point out is geographically, there's a big difference in valuation according to where a stock is listed in the lithium market at the moment. I see the Australian stocks as being, sorry, quite expensive compared to some of the North American listed names, which quite frankly look dirt cheap. So I think because the Australian market understands lithium so much better, than the North American market. If you're a global investor, there are some wonderful, opportunities in the North American equity markets in the lithium space at the moment. Some of them, have gone off like scalded cats, as discussed. But for me, there are some, production or near production assets that look fantastic value in the current environment. And I think just on the other thing, on the other commodities, um, one of the things that's most exciting about the energy transition is there's a lot of very interesting, what we would have called over the last couple of years, niche commodities that are sort of exposed to the transition, um, that are going to see, structural huge changes in their markets. And I think that there is a huge opportunity to start looking at some of these niche markets. I know some of them are not particularly niche, like uranium you mentioned. Um, you know, I think copper is a well-known material that's leveraged the energy transition, but maybe people aren't looking at aluminium, which in my view is just as leveraged. You mentioned rare earths, so there's lots of other really exciting materials um, that perhaps people are not really picking up on in terms of their scarcity factor or in terms of the demand story that could really pull them up out of the trading levels that they've been at over the last few years.
Well, one of those we didn't mention, but we had talked about it yesterday, and with the metals company and with you offline is a GM, and LG Energy Solutions and this LMR battery. You know, what's the prospects, on manganese? I mean, you've talked about that in the
Yeah.
past.
High purity manganese. So on manganese itself, sort of fair amount of it around, but high purity manganese for the battery industry, really, there's very little production capacity outside China. There's a little bit of high purity manganese in Europe, like a very very little bit, but the rest of it is development projects, and it's the processing. So, for instance, we talk about graphite being in, a fair amount of supply, but graphite in anode materials, that's in very weak supply. And it's the same thing in manganese. There's lots of manganese around, but there just isn't a lot of processing. And I think a lot of people assume, well, we can just use the manganese for the steel industry and adapt it to the battery industry. But you can't, because the manganese for the steel industry is very high in selenium, and that's an absolute no-no in batteries. So you need to go a different processing route, and there just isn't. There's one company in South Africa that produces HPEMM, so high purity electrolytic manganese metal, and then there's a company in Europe that produces a little bit of HPEMM and a little bit of HPMSM, high purity manganese sulfate monohydrate. That's why we abbreviate it. And there's nothing else, and there's a few development projects around. But if Ford and GM are going to go for their high manganese batteries, and they're going to use Western world manufactured manganese, well, then somebody needs to write some checks, PDQ, because we've got a real shortage of suitable projects over here.
Interesting. We've noticed a number of small companies in small metals. We've had obviously a very positive experience in cesium with power metals, but some other companies out there that are in, niobium or gallium or germanium are getting bids. They're very illiquid stocks, but suddenly, something captures the imagination. I think that's potentially there in the high purity manganese space. I think we were talking offline, you like things in antimony and a few other things. So Rodney and I, and with your help, are digging into some of these new opportunities. So stay tuned, all our viewers. If you want to reach out to us, we are examining some non-lithium niche metals that could be like the next turn. I do overall. I mentioned uranium's hot. you know, gold is hot, Bitcoin's been hot, deep sea minerals has been hot, American based stories are hot, but lithium and battery materials, which a few years ago were very hot, are now collectively very cold. But therein lies an opportunity that there could be great opportunities in graphite, right? Nouveau Monde is, continues to progress, but there are 5 or 6 other, viable projects out there that are starting to get, the attention of the U.S. government in terms of export import LOIs or some other activity. So, in these doldrums, again, Rodney and I, it's been good that we've been talking about cesium and deep sea mining while lithium is in the doldrums here. And I think, we'll see how soon we recover. But I think you're right on Sigma and Lithium Argentina as safe ways to play. They're producers, right? The highly leveraged to before go down into the development, stage. That's probably a good place to be. I wanted to ask you, there's an interesting comment you made that the Western Australian or ASX listed companies are trading at high valuations. And going back to, I got caught up, Gina Reinhardt, Chris Ellison, you know, iron ore, mentality. Dwayne Sparks, someone who we've spoken to offline, he's camera shy, not willing to kind of go on podcasts, but every once in a while, prolifically writes on Twitter. And again, I've been a believer in this, but over the years, this life analogy, LIFE, iron ore, Ken Brinsden has kind of talked about it. And the thesis is that a number of years ago in iron ore, the market was growing super fast, and China, kind of subsidized high cost, low grade production, and it only temporarily, solved the problem. And that's kind of like the comparison to lepidolite. Over time, they're going to want Western Australia, spodumene. But I've,
So
you know,
slightly flawed argument from my point of view.
yeah.
And just a couple of sort of obvious issues. I mean, first of all, the lepidolite, as I discussed, is not as high cost as a lot of Western commentators assume. The other thing to be aware of is there are actually quite substantial spodumene ore bodies in China. They are in slightly difficult to get to regions like Tibet, but a little bit of infrastructure investment never worried the Chinese before. So I think, that's a slightly concerning issue. The other issue is that I don't agree with the lithium versus iron ore comparison from the point of view of ore body type and scarcity. So what we actually find over the last 2 or 3 years is that it's not difficult to find lithium ore bodies. There's lots of them around. On the hard rock side, not talking about salar lithium or certainly high grade salar lithium. That is very difficult to find. But hard rock lithium assets, they're everywhere. People are finding an increasing amount of geothermal brines and low-grade salar brines as well that could be amenable to DLE if it works. So, I don't think there's a scarcity of lithium ore bodies. And the point about iron ore is that, yes, iron ore is quite common, but the big issue with iron ore is whether you can find a high enough grade iron ore deposit with associated infrastructure. So with iron ore, you've got to look at it as grade and size and infrastructure ability. And for instance, with the Simandu iron ore project in Guinea, that's taken Rio 10, 12, 15 years to develop. You've got to balance off the geopolitical risks, the cost of the infrastructure corridor against the sort of returns of the assets. And iron ore is all about infrastructure because it is the bulkiest of bulk materials. So I think a comparison with lithium is a bad comparison, quite frankly, because yes, iron ore is quite common in nature, but viable to develop iron ore projects with the right mineralogy, the right grade, the right size, and access to infrastructure, those are damn difficult to find. So I just don't think it's a valid comparison, I'm afraid.
Okay. Rodney just dropped off for some reason here, but when I asked him about it, he said it as simple as this. Rio Tinto and BHP in iron ore, they're the low cost producer out of the Pilbara. But in lithium, the low cost producer is not in WA at the moment. And if you think about the iron ore analogy, Rio Tinto entered lithium by buying brines in Argentina and now investing in Chilean brines, right, with a little bit in Quebec. So if the analogy were perfect, like why wouldn't they buy Pilbara? Like why wouldn't Rio kind of get in the game in Western Australia? And maybe Rio Tinto, who's been studying this with Yadar, I don't know, for 15 years, has a bit more experience than, iron ore mentality, Gina Reinhardt or Chris Ellison, also iron ore
Yeah, I mean, I
mentality.
think when Rio first announced that it was going for Arcadium, I was a little bit sort of dumbfounded. But then I realized Rio, with it, sort of has a big portfolio of assets, and for Rio, it's always about optionality. And obviously, Arcadium offered massive optionality. A interesting portfolio of high grade brine assets in Argentina, but also the optionality of the hard rock assets in Canada if they wanted to push forward with that. And then obviously since then they've got involved with the Maricunga assets and the Chilean assets as well, which again are high grade brine assets. So it's very clear that Rio is focusing on sort of the bottom quartile of the cost curve for its brine, but obviously it also has the optionality of the higher cost hard rock assets in Canada if it wants to go forward with that, if there's, strength in the lithium price that it sees lasting for a long time.
And I want to finish on both of related to that. You mentioned Simandou. Rio's in Simandou. Also in the news has been, uh, peace agreement today, potentially, in the DRC and Rwanda, facilitated by the U.S. And behind that, all the Monono ABZ people are excited. Cobalt was in there, an American backed, startup. So, what are your thoughts on the prospects of the DRC, and that project developing for lithium and also for Canada? Because the hard rock narrative, we've had an election with Mark Carney, like within lithium land, Ken Brinsden's doing as good a job as he can, promoting, patriot and belief there. But from a lithium perspective, uh, Canada is kind of fallen off the radar screen, over the past kind of 6 months. So what do you think about those two jurisdictions, hard rock,
So
spodumene?
I think with Monono, certainly, Nigel and the guys at AVZ were sort of veering towards the lithium sulfate before all of this issue with the license rose up and became an issue. So obviously the lithium sulfate is like an intermediate product. So instead of having to transport sort of spodumene concentrate, which is like 5.5% over quite an extended route if you're in the DRC, you would basically upgrade it to lithium sulfate. And then you get a little bit more bang for your buck. You've got a much higher lithium grade. It's an intermediate material, and then you can ship it to Europe or somewhere else where it would be further refined into hydroxide or carbonate. So I think that's something that probably whoever ends up developing that asset will probably look into, because the trucking distances are really substantial. And whereas it works for something like copper concentrate, which is a very high value product, it doesn't really work in the same way for spodumene concentrate at the current time. I think in Canada, if I was them, I would look at something similar, because again, the issue that you've got with those very big, high grade assets in the far north of the country, I won't say the far north, but certainly in the north of Quebec, is that you're a fair ways away from, for instance, the Bécancour chemical plants that are under development or certainly being planned, you've got to ship quite a long distance. So maybe the lithium sulfate intermediate level is something that they might want to look at in that area as well. I don't know what the availability is of sulfuric acid and other reagents there. Obviously, in the DRC with the copper smelting industry and everything that you've got there, there's not a problem for availability of sulfuric acid and whatnot. But certainly for me, that would be an area that the Northern Canada projects might look at to lower their operating costs. But at the end of the day, the mineralogy of those projects in Canada, in Quebec in particular, is really exciting. So the geologist in me loves those assets and is very excited about them. But obviously in this market, but if you had hydroxide plant in Quebec, cathode manufacturing in Quebec, you don't have to worry about the sort of shipping it to China. Then you're just going elsewhere in Quebec. Um, but if you go the lithium sulfate route, then you're taking your operating costs down considerably. So maybe that might be something that they would consider doing.
Interesting. We wait to hear. I heard that Rio Tinto may have some sort of investor day, by the end of the year, and kind of go through all of their assets and maybe articulate some vision for Quebec. They've been very quiet on Quebec as they've pursued things in Chile and Argentina, but they're going to have a new CEO, so we'll see what happens, for that. So that's a bit in flux. And you mentioned this sulfate thing. Sorry, now I have another question. Zimbabwe was in the news earlier this week about saying, I think from 2027, they won't allow just export of spodumene concentrate. I think they're going to force into sulfate. So, and this is something that Pilbara has been doing, I think, with calyx. I'm not sure if it's sulfate or some other intermediate, but I guess is this the future for maybe long distance infrastructure problem, hard rocks, that the future is building these intermediates, and that'll make these projects
Yeah.
more viable.
I mean, it very well could be. I mean, the Zimbabwean sort of news was actually not new news, although it did generate quite a lot of column inches. The Zimbabwe has been talking about this for sort of 12, 18 months, 2 years or so. Um, and they sort of fluctuated between whether they were going to impose it or not. And then I know that a number of the Chinese developers are already developing either sulfate plants or other type plants to process the lithium. So yeah, I think increasingly there's a need to go to some sort of intermediate material, because moving 5.5% concentrate around isn't great from a cost point of view, and it's also not great from an environmental point of view in terms of the carbon intensity. And the carbon intensity of the manufacturing process in electric vehicles is very much in vogue, in focus in a lot of areas. So yeah, I think that increasingly we will see sort of projects that are landlocked going towards this sort of solution.
Great. Thanks for that, Brian. Did you have any other questions?
No, that's good. Thanks, Matt.
All right, Matt, thank you as always, and look forward to having you back on. Matt, you can follow Matt on X as well. I forgot to mention, I think it's at Matt Fernley 1. Okay, we'll flash that up on the screen so you could follow him as well. And he's also prolifically writing on LinkedIn. So follow Matt on LinkedIn and X. And yeah, then you can go to his website, I think Battery Materials Review, and you can subscribe to his publication there. Thanks again, Matt.
Thanks so much.